A well-maintained S-Corp looks like, and I see what happens when things slide. Miss Payroll, and I see what happens when things slide. Miss Payroll deposits, late filings, each one creates a compliance issue that's more expensive to fix than to prevent. The last two episodes were about whether the S-Corp makes sense for your business. The math, the reasonable compensation analysis, the break-even calculation, all of that matters, but it's all theoretical until you actually have to operate the thing. Today is where theory meets reality. We're covering the operational mechanics, payroll, quarterly filings, the salary distribution order of operations, shareholder basis, corporate formalities, and then we're going to talk about what happens when you make this election before your business is ready for it. Because electing too early is one of the most common and most expensive mistakes I see. Welcome back. I'm Lauren Twitchell, enrolled agent, founder of Zero Flip Books, and former IRS revenue agent. At my firm, I work with S-Corp clients on these requirements every month. I see what a well-maintained S-Corp looks like, and I see what happens when things slide. Miss Payroll deposits, late filings, distributions taken before salary has been paid. Each one creates a compliance issue that's more expensive to fix than to prevent. Let's start with the biggest operational change, payroll. As a sole proprietor or a disregarded LLC, you moved money from the business to yourself whenever you needed it. Owner's draws, transfer to personal, done. That's over. As an S-Corp shareholder employee, you pay yourself through formal payroll, a set pay schedule, tax withholdings calculated and deducted from each paycheck, and those withholdings deposited with the IRS according to the deposit schedule. You receive a W-2 at the end of the year. This isn't optional. To run payroll, you need a system. Gusto, ADP, QuickBooks Payroll, or something comparable. The service calculates withholdings, generates pay stubs, handles deposits, and prepares quarterly and annual filings. Every quarter, the S-Corp files Form 941, the employer's quarterly federal tax return. This return reports wages paid, federal income tax withheld, and Social Security and Medicare taxes. Missing a 941 filing or a payroll tax deposit is one of the fastest ways to generate an automated penalty notice. These penalties aren't small and they accrue quickly. If you're using a payroll service, the filings are typically handled for you, but you're still responsible for making sure they're filed and deposits are made on time. Now let's talk about how you actually receive money from the S-Corp. The order matters. You have two types of payments, salaries and distribution. Salary is your W-2 compensation, subject to payroll taxes. Distributions are the remaining profit, not subject to self-employment tax. You must pay yourself a reasonable salary through payroll before you take distributions. If the IRS sees distributions taken while no payroll has been run or while the salary is unreasonably low, they'll reclassify those distributions as wages and assess the payroll taxes plus penalties. In practice, run payroll consistently throughout the year. Don't skip payroll for 6 months and take large distributions. A consistent payroll schedule with a reasonable salary followed by distributions from remaining profit is the structure that holds up. I want to touch on shareholder basis because it affects how distributions are taxed. Basis is your running balance of investment in the S-Corp. It starts with your initial capital contribution, it increases with your share of income, it decreases with distributions and losses. You can generally take distributions tax-free only up to your basis. Exceed it, and the excess can be taxed as a capital gain. If you don't track basis, you won't know where that line is until it's too late. Basis tracking is part of annual tax preparation, not something the payroll service handles for you. Your tax professional should calculate it each year. If they're not, ask about it. The S-Corp files Form 1120-S due March 15th. This return includes a balance sheet, which means your books need to be fully reconciled and accurate as of December 31st. If you're behind on bookkeeping in January and the return is due in March, the window is tight. This is why I emphasize keeping books current throughout the year. Beyond the return, document major business decisions in writing. Purchases of significant assets, major contracts, decisions that materially affect the business, even as a single shareholder S-Corp. This documentation reinforces that you're operating as a formal entity. Now let's talk about what happens when you make this election too early. Every tax season, I see the same situation. A business owner with $20,000 or $30,000 in net profit is paying $3,000 to $5,000 a year in S-Corp compliance cost. The tax savings from the election are smaller than the cost of maintaining it. Let me put numbers to this. If your net profit is $30,000 and you set a reasonable salary of $25,000 because at that profit level, most of the income is compensation for your work, the amount shielded from self-employment tax is only $5,000. At 15.3%, that's roughly $765 in savings. $65 against $3,000 to $5,000 in additional cost, you're losing money on the election. The reasonable compensation requirement compounds this at lower profit levels. If the business nets $40,000 and you're doing all the work, it's difficult to justify a salary significantly below that amount. There's not enough room between reasonable compensation and total profit to generate meaningful savings. There's another factor that rarely comes up. When you reduce income subject to Social Security tax, which is what the salary distribution split does, you're also returning earnings that count toward your Social Security benefit calculation. Over time, that can affect the benefit amount you receive in retirement. It's not a reason to avoid the election when the math supports it, but it should be part of the analysis. So, what's the alternative if you're not ready? You wait strategically. I recommend seeing consistent profit, not one good quarter, but sustained profitability over 6 to 12 months at a level where the break-even math clearly works. During that waiting period, build the operational discipline the S-Corp requires. Get bookkeeping current. Set up systems that could support payroll. Research comparable compensation. If your business takes off faster than expected and you miss the 75-day window, late election relief is available in certain circumstances. Filing a late election for a business that's genuinely ready is better than filing an early election for one that isn't. And revoking an S-Corp election after you've made it is not simple. It has tax consequences and procedural requirements. It's significantly easier to delay the election until you're ready than to undo one that was premature. Here's the bottom line. The S-Corp is a system. Payroll, quarterly filings, a separate corporate return, basis tracking, documentation. Each part needs to function consistently. If you've made the election, check your setup this week. If you're considering the election, make sure the math works over multiple years and your operations can support it. Next week, the C Corporation. A completely different structure, taxed at the entity level, income doesn't pass through to you, and designed for a business model that most small business owners don't need, but some absolutely do. I'm Lauren Twitchell. Keep the fluff out of your books, and I'll see you next week.